first and foremost, we need to understand what a company does, what makes them unique, why they earn their returns, why they earn their cash flows, and why that'll be able to sustain going forward. What our goal is, what our intention is every day, is to come to work and better understand the businesses that we currently own. Now that doesn't mean myopically focused on just the 40 or so holdings that we have in the portfolio, but it's understanding their entire value chain, understanding why a supplier is able to do business with a given company. And so by doing that, by understanding all the different levels in a value chain and understanding where the profits are accruing and where they may accrue in the future, we then better understand the businesses we invest. And through that, sometimes we find new investment ideas that are in those value chains. But when we're investing our clients' capital, we're not investing based on what's happened. We're investing based on where we think a company's going. And so if you're using a screen to focus on backward-looking data, you may miss the future. You may miss the transformation. You may miss the catalysts that we see in our investment process. So importantly, we do not use screens because we view them as exclusionary and backward-looking.
In looking at companies, there are three aspects to our process: identifying high-quality businesses, looking for them when we think they're inexpensive, and identifying investment catalysts that we think can take that business to the next level. From a fundamental standpoint, looking at the financials of a business, what they've been able to achieve over a long period of time, understanding management teams, looking for individuals who have demonstrated success in the past. Combining all of those factors together, I think, is unique in our process in that all of those factors come together to give us a fuller understanding that we're dealing with a business that we do believe has a competitive advantage. Valuation is important, but it's not the starting point for us. There has to be some reason away from valuation that we would believe that this business can achieve some success. We all want to understand what makes this company unique. Why is it a greater competitor in their space than others? And identify whether or not the company's been able to build a moat around that business model that would allow them to be successful for an extended period of time.
Our process starts by identifying great businesses, and we want those to be undervalued. But it's not enough. This is why it's very important that we identify catalysts. Catalysts are events that are currently taking place, but that will develop over the next 3 to 5 years. And what they will do is they will close the valuation gap over that 3 to 5 year time horizon, meaning they should drive the stock price to what we estimate is the true value of a company. What are examples of catalysts? Could be a restructuring of the business or initiatives that are going to improve margins over time. It could be a change in management or control. It could also be divestiture of certain businesses that are underperforming or that are not in the core competency of the company. It's very important to understand what a catalyst is, but as important is to understand what a catalyst is not. And catalysts are not things we're hoping for, things that may happen in the future. Catalysts are not external factors that are outside of management control. External factors can be positive for a company. So if a company suddenly sees lower commodity prices and they're buying those commodities, that can certainly help a company. But because that's outside of management control, we do not include that in our valuation, and we do not consider that a catalyst. We look beyond the short-term news of the days. We look beyond the next few quarters, even the next year, to focus on the evolution of these catalysts over time. Change takes time, and so by focusing on the next few years, we can actually monitor the catalyst little by little as they develop, because we know that over time, those catalysts are actually improving the business fundamentals. Ultimately, our conviction is that the realization of these catalysts, it's what is going to turn a great company into a great investment.
Understanding businesses, having some sort of additional insight into industry trends, and that's where we're adding value for our clients. Our investment process is optimized to avoid the noise of the markets and identify what we believe to be the long-term winners. When we invest in a company, we'll invest with conviction. Our interest isn't, do we want to own this company at 3.5%, 3%, or 2%? The question we want to answer is, do we want to own it or not? And if the answer is we don't want to own it, we sell it. And that's one of the benefits of managing a concentrated, fully invested portfolio. Trading stocks is very exciting. It's very tempting. It's very satisfying to feel like you're doing something in this business. What can happen is the market can distract you from, at the end of the day, what your original purpose is. That's investing in a business. It's not trading a piece of paper.